If you ask most commercial real estate experts which product types they like the most, given everything going on in the economy right now, multifamily and industrial will likely be on the top of that list. But while it appears that industrial will continue its upward trend throughout the rest of this year and into 2021, multifamily might not have as much of a positive future ahead, and there are a few somewhat alarming red flags in the apartment space right now that could spell trouble for the product type as a whole later this year. So whether you're working for a multifamily focused investment or brokerage firm, or you're a real estate entrepreneur looking to buy multifamily deals, in this video we'll break down a few key things you'll want to keep your eye on throughout the rest of 2020 and heading into next year. Hey, this is Justin from BreakingTheCRE.com, and if you're new here, on this channel we talk about real estate investing careers and real estate investment analysis. So if you're looking to break into the industry or do your first or next commercial real estate deal, make sure to subscribe to the channel and hit the notification bell so you don't miss any new videos as soon as they're released. So multifamily has been an extremely popular asset class throughout the past decade, and that has continued throughout all of the uncertainty that has come to the forefront in 2020. The argument goes that people always need a place to live, and with home prices for single-family homes continuing to increase in most US markets and multifamily supply not being able to keep up with demand, this has rang very true as apartment rents and values have skyrocketed since 2010. However, after what has been an unexpectedly strong first 3 quarters of performance for apartments throughout this whole situation we're finding ourselves in, the multifamily sector is finally starting to show a few warning signs that investors should be aware of if they're in the space right now or thinking of getting into the space in 2021. So in this video, what I wanted to do is walk through 3 things multifamily investors should be watching right now and what each of these things might mean for apartments going forward. So let's start with the first warning sign that I see as a potential red flag, and this is going to come as no surprise to many, but we're starting to see a significant increase in concessions to lease multifamily units. Now, if you're not all that familiar with multifamily terminology, concessions are just a fancy way of saying apartment owners are offering deals like the first month of rent-free to incentivize renters to move into a unit. And not surprisingly at all, concessions are up significantly this year, and we're starting to see an upward trend in concession volume as we get deeper into the year and start to head into the new year. So to put some stats behind this, a report from Fannie Mae released last month found that the overall percentage of multifamily units offering concessions jumped to as high as 16% in May of 2020, up significantly from just 8% of units offering concessions in May of 2019. And even though these levels have dropped somewhat over the past several months, back to around 14% as of the most recent data in August, the overall national multifamily concession rate, or the value of those concessions on individual units, has shot up every single month since March and has increased to almost 8% as of the most recent data in August of this year, or approximately 1 month of free rent, with normalized values from 2018 and 2019 only hovering at about between 5.75% on the low end and 6.25% on the high end. The report also found that many major markets are seeing a surge of supply coming online, which will very likely make this situation even worse, with already hard-hit areas like New York, Los Angeles, and Washington, D.C. seeing some of the highest levels of activity for new apartment development. New York currently has over 71,600 units underway, with Washington, D.C. and Los Angeles at a little over 25,000 units each, and this is not good news for rent values in these markets, with rising supply and quickly falling demand as people continue to leave major cities in search of a lower cost of living. And expensive markets like Boston, Los Angeles, New York, and San Francisco have already seen a major impact of outbound migration in 2020, with concession rates in these cities almost doubling in each of these markets since the beginning of the year. Again, not surprisingly, concessions on new Class A multifamily product have been leading the charge here, with concession rates hitting over 9% nationally in August of this year for these properties. And as with any product type, when rents drop and concessions increase in Class A product, this can often trickle down and have a direct effect on Class B and Class C product as well, which could also spell trouble for owners of older apartment properties in fringe areas of major metros and even suburban product as well. Now, aside from increasing concessions on apartment units this year, another somewhat alarming red flag in the multifamily industry that we're seeing right now is a recent spike in late loan payments for both agency and non-agency loans, according to Moody's Analytics. Late payments for agency loans jumped from 0.46% in August all the way up to 1.4% in September of 2020, and non-agency late payments rose from 1.83% to 2.78% during that same time period. And again, this could be related to additional unemployment benefits ending, with some highly leveraged properties potentially experiencing some cash flow issues if delinquent payments spiked as a result of ending unemployment checks. MRI also found that credit card usage for rent payments increased by 60% since January of this year, which could also be an indicator of cracks starting to form in the multifamily market once those credit lines start to become tapped out. And finally, aside from concessions and late payments increasing, the final big warning sign we're seeing for multifamily, and probably the most impactful of all three, is how quickly rents have been declining this year in many US markets. According to Moody's data, national asking and effective rents dropped in Q3 by 1.8% and 1.9% respectively, which represents the largest quarterly decline in these figures since 1999, which was the first year this data was tracked. Only Q4 of 2001, the quarter directly after 9/11, came anywhere even remotely close to these numbers, and even in Q4 of 2001, asking rents have never declined by more than 0.7% in the last 21 years tracked before Q3. Major metros like New York City and Boston have been hit disproportionately hard with these rent drops, and the median rental price in Manhattan dropped 11% year over year, according to the appraisal firm Miller Samuel and brokerage Douglas Elliman, and over 55% of those leases signed contained some sort of rent concessions. Outer boroughs of the city haven't been immune from rent declines either this year, with median rents in Queens dropping 12% year over year, and almost 63% of leases signed this year in the Queens market have had some form of rent concessions included. In Boston, rents have fallen 12% year over year, according to Apartment List, and 9% since March, and collections have also become a major issue in this metro, with Boston landlords collecting only 68.6% of rent between October 1st and October 6th of this year, down almost 12 percentage points from the 80.3% collected during the same time period in 2019, according to RealPage data. And New York and Boston aren't the only major markets taking a hit, with Apartment List rent figures derived from listing data estimating that rents have dropped over 20% in San Francisco between March and October, with New York, Seattle, Boston, San Jose, and Washington, D.C. all seeing drops between 10 and 15% during that same time period. So overall, that sounds like a lot of bad news and doom and gloom, but there are some things that are still positive signs in the space and opportunities that might arise because of everything going on in multifamily today. So first, with distress comes opportunity, and with rents plummeting and concessions spiking and no end to supply growth in sight for many major US cities, there is likely going to be some opportunity coming up in major metros to buy new product at a discount, likely well below replacement cost. Developers might need to get out of their deals, even if they're well located and well built, due to not being able to refinance their construction loan or lease up their property to pro forma estimates, and well-capitalized investors that can weather the storm for 12 to 24 months until the country starts to stabilize a little bit more might be able to find some really good deals in this environment. Now, aside from the potential opportunities that might arise over the next year, it's also important to note that in most markets, renters are still paying the rent that they owe, even if rents are dropping across the board. According to the NMHC Weekly Rent Payment Tracker, which tracks 11.4 million professionally managed apartment units, national rent collection has hovered between 94.5% and 96% since May, and this continues to be relatively stable despite so many concessions and rent drops in major markets. And this may change as we go longer without a clear plan to include additional unemployment assistance, and if we see additional shutdowns and closures start to reoccur over the winter months, but this is a good sign for now and definitely a metric to be optimistic about if you're in the multifamily space today. And finally, it's also important to note that most of the major rent damage has occurred in high cost of living areas, and some markets have actually thrived this year with changes in net migration and renter behavior. With remote work possibilities growing and people moving out of larger cities, smaller markets like Albuquerque, Colorado Springs, Virginia Beach, and Tucson, Arizona have all seen estimated rent increases between about 4 and 6%, according to Apartment List data. This just goes to show that there are always opportunities in real estate, regardless of how dire the situation might seem in certain cities or specific types of properties, and you just need to follow trends to spot those opportunities that might not be your typical investment targets. Overall, we just don't know what's going to happen over the winter and into next year, but with supply continuing to be delivered in major gateway markets, at the same time, millions of people are fleeing those cities. Right now, this is creating some significant distress for property owners of new Class A product in expensive coastal markets, which could mean significant buying opportunities later this year and into 2021 for well-capitalized investors. So I hope this was helpful if you're working for a multifamily focused company or you're looking to buy your first multifamily deal next year. And if you are looking to take advantage of the opportunities that might arise as a result of everything that we talked about in this video, and you want to make sure you're prepared to run the numbers to analyze deals that might come your way, as always, make sure to check out Break Into CRE Academy, which is going to give you instant access to all Break Into CRE courses on real estate financial modeling and analysis, all Break Into CRE models and templates, and some additional one-on-one career support from me directly along the way. Also, make sure to let me know in the comments if there are any multifamily markets you're bullish on right now. And if you like this video and want to see more content like this, make sure to like the video to let me know and subscribe to the channel so you don't miss any new videos as soon as they're released. So thanks so much for watching. I hope this was helpful, and I'll see you in the next video.